Good afternoon, everyone. This is Brian Lenz, Director of Sales here at Epic Retirement Plan Services, and I'll be your MC for today's call. We are pleased to have Matt Stubblefield and David Campbell with us from Dimensional Fund Advisors. They are both regional directors and have a great background in working with advisors and consultants for well over a couple decades. Dimensional's focus has always been on investment solutions that help both plan sponsors and ultimately plan participants achieve better outcomes, which aligns very well with our mission to help America retire. And today they're going to focus on prevailing trends around competing for DC plan business and offer some solutions to help you differentiate your practices. As always, your line will be muted, but if you have any questions you'd like me to run by Matt and David, please enter those in the questions panel, and I will field those at the tail end of the call today. With that, I will turn it over to Matt.
Great. Yeah, thanks, Brian. Good afternoon, everyone, and thank you so much for having us today. I had the pleasure of attending the national conference down in New Orleans, I guess maybe 2 or 3 weeks ago, so I thought that was very well run. Really looking forward to working with all of you. David on the team here, he's put together a lot of great work for fiduciary resources and sort of practice management resources for our retirement team here at Dimensional. So, no, he's certainly looking forward to presenting that to you all today. So, David, I'll hand it over to you.
Great. Matt, Brian, thank you so much. Again, we appreciate the partnership. Glad to be with you guys and share this content with you today. So our team is, Matt and I both are regional directors, and so we have the opportunity to meet with lots of different advisors across the country, both large and small. And when we ask them, what's most important, what's top of mind, oftentimes we hear a couple key themes. First, fees have compressed, technology has become more robust, and there's just more challenges in terms of how do I stand out, how do I differentiate my firm. And so we'll get into that as we talk a little bit more about how the business is becoming more institutional. But we also see that there's this interest and concern as advisors start to, non-specialist advisors particularly, once they start hitting that 10, 15, 20 plan kind of threshold, they become a little bit more anxious. And so the main themes again tend to be differentiating the firm, creating efficiencies to build and run the business without adding staff in a linear way. So we conduct one of the country's biggest surveys across our client base, and it's really interesting to see what's going on, what's top of mind, and we break out our content for the responses of our survey into a couple of different buckets. Those that are top performing funds and those that are not. So those top performing funds are ones that are selling plans on a regular basis, at least 3 to 5 plans regularly, and the bottom 75 are those that are not. And so one of the key questions that we ask every year that we do the survey is, where are your clients coming from? Why are you getting hired? And this plays into the value proposition. So the 3 F's are still important: high fees, lack of fiduciary oversight, record-keeping partners, and servicing levels. So those are still relevant, but participants, whether or not they're on track or off track, plan sponsors are more and more concerned with that, particularly as you start to move up market. And so those are the things that are, we continue to hear resonating in terms of new business. And so as we go through the content today in the presentation, we're really focusing on just that. So what does your current value proposition look like? What's important to you to grow the business? And then we'll shift gears and we'll talk about plan sponsors. What's important to them, and how can you incorporate those considerations into your sales narrative as you talk about your firm and potentially sharpen your value proposition. So again, these 4 pillars I'm showing you here, these are what we think of as key principles to grow the business for those that are wanting to perform at a higher level for DC plans. So lower fees, fees are still very important, and for smaller plans, they continue to be the driver. Managing risk, reducing liability, delegating more tasks, creating scale for your business. That's top of mind for sure. But again, it's that fourth F, financial wellness. That tends to be a differentiating factor for those firms that are growing at a higher rate, and particularly wanting to scaffold up for those larger plans. And so as we think about that, it doesn't have to be that you're going out and you're purchasing, the software packages themselves. It can be that you partner and you delegate a lot of those functions to your partners. So your record keeper, Brian and Chris, to us. We can all work together to support you in those areas. So I think about 529 plans, college savings arrangements, et cetera. All of these things kind of come together to produce or present a financial wellness arrangement. And so Brian, how do you guys think about partnering with advisors, and how can you support that financial wellness offering from a record keeping perspective?
Sure. Our approach is more about enabling what our advisor partners want to use. We have found a lot of differing and strong opinions on what tools and what approaches make sense, and even what definitions are involved here. So one thing we have done is integrated into our web and mobile technology a complementary wellness tool that participants can access and engage with, but we're also open to integrating our data and systems with third-party providers that our partners are looking to leverage. So
that sounds absolutely spot on.
Primary take.
Yeah, and I guess again the takeaway is you can leverage many of the tools and resources that are available, incorporate that into your pitch deck and your offering, so you can check the box. You can provide that level of service offering that plan sponsors are looking for. Again, for those that are wanting to grow that business. And so as we think about where you're investing, where are advisors allocating their resources from a technology perspective primarily, and we come back to fee benchmarking, fiduciary governance training, financial wellness. Again, it doesn't have to be something that your firm is specifically purchasing and providing. You can leverage the tools of others. And so the due diligence, the benchmarking, plan design, cost analysis, these are where technology is adding to the offering. And then if we think about the investment services that are being offered, 321 services, 338 with discretion, monitoring investment policy statements, asset allocation models for wealth models, et cetera. Essentially soup to nuts across the board. These are the things that plan sponsors are looking for. Certainly moving away from that registered rep model or non-fiduciary role, moving towards the 321, 338. One of the things that I think is interesting, and we've just begun to hear it maybe over the past 9-12 months, is a migration, is a shifting from 321 to 338. And part of that is plan sponsor demand for sure. But advisors are telling me, look, if I'm just serving as a 321 and I'm relying on the plan sponsor to actually effectuate and carry out these changes, if it's a fund change, a lot of times it doesn't happen. And so if I come back to them 6 months later for another review, they failed to carry that out. They didn't provide notices to plan participants. They didn't engage with the record keeper to actually make the fund change. And so then we're back to the drawing board and I have to do another screening. So I think that's just kind of an interesting change or shifting that's taking place from an operations, from an efficiency perspective within the advisory firms. So kind of an interesting anecdote, and we'll see if that continues. From a fiduciary offering perspective, again, really kind of across the board, looking for educational training, looking for benchmarking. I will say that this kind of, it falls in line with some of the other trends that we're seeing kind of across the board. And we'll touch on this in a moment as we get into more of the fiduciary things, but plan sponsors, I think are looking for a lot of services that used to be, associated with large and jumbo plans. Think of that fiduciary education, the training services, think of committee charters, et cetera. we're seeing some of that move downstream. And I think part of it is it's driven by the class action lawsuits, the litigation. And so as you start to see 150, $100 million plans become targets of these lawsuits, plan sponsors are now perhaps more aware of their charge, their duty, than they've ever been. And so they're looking for support from their trusted advisors. And so I think that plays into the service offering. And then if we shift gears, we've talked about how you put together your offering, your value proposition, and part of that is informed by the plan sponsors for sure. But Callan puts together an annual survey every year, and it highlights a lot of the same things that we see in our survey, which is great across really all plan sizes. And that is the need for somebody to lead, guide, direct, and provide that coaching on all things fiduciary. So certainly fund screening, but more broad topics, and help me understand what ESG means and how should I be thinking about that. Help me understand what a good investment policy statement looks like. Should it be very specific or should it be more broad? These are the kinds of things that we're seeing through the surveys. And that plays into our approach for the Fiduciary Resource Guide. And this is a tool to provide you guys to step up your game and be able to deliver these kinds of solutions to plan sponsors. So super excited about this. We engaged DLA Piper on the legal front for the investment content. Blaine Aiken, formerly with FI360, partnered with us. And we also had contributions from Warren Comier from DeCia, a bit of a think tank. Many of you may not be familiar with him, but he's done a lot of work with Shlomo Benartzi on the behavioral finance side of things and helping just better understand group decision making and avoiding group bias, just structures for plan sponsors. Now we put the guide together to provide some flexibility for you guys. So it's well over 100 pages. We'll send this to you after the webinar for sure. And it's intended to touch on a variety of different topics, very much like you've seen with other fiduciary guides. But we really have taken a different approach in the sense that we wanted it to be more practical. So create something that you guys as advisors can use in your day-to-day practice, not just the legal side of things, although it certainly has that, but on a more practical basis, how can I provide value to plan sponsors on the things that matter day to day? And so we've got the content, and we also provide 3 quick takes for each one of these topics. So it's a best practice, it's a pro tip, we build all of that out, and we give you the key themes to have these conversations with plan sponsors. And we put it all together in terms of a unbranded PowerPoint presentation that you can deliver with confidence. So we're giving you the talking points. You don't have to know everything there is to know about each and every one of these. The point is you can engage and have conversations that are typically not taking place in that small to mid-size space. So starting with foundations, we get at the requirements for setting up a plan, roles, responsibilities, gives you an opportunity to highlight the things that you're doing as an advisor and what's still left for the plan sponsor. I touched on committee structures. This is really great content, guys. We understand small plans, everybody doesn't have a committee, but even if it's not a formal committee, and there's just a principal making decisions, it's still really good content to help them understand, gee, what should I be aware of to make good decisions? And if I do go the route of a committee, should I have 2? Should I have investment? Should I have administration? Does that provide cover? Does the committee have decision-making authority, or is it simply an advisory function to the board and the company is still responsible? These are all nuances, but it's great conversation material for sure. As we shift more towards the day-to-day, applications is what I think of as the core of the material. Here we get into mitigating fiduciary responsibility, liability, still with an eye towards better outcomes for participants, but providing a great structure for the committee. Does the plan sponsor indemnify them for their actions when they're dealing in good faith? Asset allocation solutions. risk-based models versus target date funds. All target date funds are not the same in terms of asset allocation, equity positions at retirement. Quite a disparity. Some target date funds are going to be as high as 55% equities at retirement. Others might be as low as 25. And so how do you evaluate them? How do you compare those? How do you think about the goals of the plan sponsor? Is it more akin to asset accumulation, or is there a need to target income or consider income? And should that play into the investment solutions that you offer? Should there be a connection there? And then we also deal with benchmarking and evaluating fees. Selected topics include cybersecurity and tips for compliance, CITs. We most recently completed our ESG component. We can send to you as well to help you have those conversations with plan sponsors. Cybersecurity is certainly a top of mind. And Brian, I might turn it back to you again just to kind of get your thoughts on the things that you're doing, because I don't think all record keepers approach it in the same way, safeguarding assets for plan sponsors.
Yeah, appreciate that, David. I mean, this is an area where being owned by a publicly traded and highly regulated bank works to our advantage, and we're subject to all of the same infrastructure requirements and security and controls and audits that the rest of the bank is. So that really bolsters our defenses there and gives us a strong infrastructure to rely on. So, we're an open book when it comes to that stuff, and happy to provide details to anyone. And we are also constantly evaluating the situation and securing particularly monies coming out of plans. So we've doubled down on integrating tools to, for example, match ACH recipients to the owner of bank accounts and integrate out-of-wallet questions and really secure that online distribution portal for us, making that our most secure channel of getting monies out of the plan. So a big focus for us and will continue to be.
That's great to hear. And I know that plan sponsors are thinking about that. If an advisor is able to document a checklist and go through that type of due diligence, all the things that you guys are doing, and have that for the plan sponsor that they can include it in their fiduciary file, that's a great service that you can provide. And again, everybody is not doing that. So you really step into the role of a consultant when you're having these conversations. You're digging in, you're doing the homework for the plan sponsor. They know they need to do it, but they're not sure how. And so what you find through all of this is that you have engagement, deeper engagements with clients, and they begin to trust you and come to you on matters, far beyond investments, for sure. And that's exactly where you want to be. So if we think about, practical ways to use the guide, there's education and there's business development prospecting. From an education perspective, building up the domain knowledge, the knowledge base of your staff. Maybe you've got a generalist advisor doing both wealth management and DC. It's a great way to shore that up. And we talked about the education for plan sponsors. That can be for new relationships to level set as part of your offering. But maybe you double back and you say, okay, for existing clients, let's make sure that they know what they need to do as far as their roles and responsibilities. And it gives you a way to have more face time, just to build up that relationship. And as members come in and out, they're bringing with them their own kind of thinking and bias, perhaps with other providers. So that if you've got a new treasury person or a new HR director, it's a great way to help make sure that they're where they need to be, and you can at the same time demonstrate your value as the advisor. So existing relationships, benchmarking at the end of the year, it's a great way to just solidify that relationship, looking for opportunities to engage. From a prospecting perspective, you can take any of these topics, take the unbranded material, incorporate that into your drip campaign, wrap a few sentences around it, include a call to action to reach out to you. And I think that will strengthen your prospecting efforts as well. Putting it into practice, again, we've got the discrete separate modules for each of the topics I described, and we also provide the unbranded content. We'll share this with you guys as well. But again, it's something that you can immediately implement into your day-to-day and start having an impact. So in many ways, we're doing the back office work for you, developing the content, formatting it. You're literally dropping your logo on this content and beginning to engage with clients. So the reception has been really, really strong. We started with value proposition, how you guys are situated today, what top performing advisory firms are doing, what's important to plan sponsors from a fiduciary perspective. If you can add that into your narrative as you develop and continue to refine your value proposition, that strengthens it based on what clients are telling us. And then how do we put it into practice? We touched on our unbranded material, but as you think about your pitch deck and your finalist meetings, the opportunity to just strengthen your narrative. Start with client goals. Don't go into meetings with what you think is important. Start with questions. Where have they been? What's been successful? What's important to them? And then work into your firm overview, how you're working with clients so they can envision what that looks like. Include their logo on your presentation materials alongside yours. They can begin to feel the partnership with you. And as you build out your annual servicing plan, you're focusing on how they can delegate further services to you, with you, and lighten their load. That's all really important. So at the beginning, again, you're driving the meeting based on what's important to them. We'll share this with you as well, but we've put these decks together in a way where you can ask the question, is fiduciary governance important to you, or are you more concerned with delegating tasks? These buttons at the bottom of the deck, that allows you to quickly move to whatever is important to them, and they can literally feel like they're driving the meeting, or you're positioning things based on what's important to them. So I think that's really helpful, and just highlighting some of the content that's available to you, from the Epic, websites and so forth. Giving them a sense for what it's like to work with you on an ongoing basis, calling out their responsibilities, calling out yours. And the more you can take on, it increases the opportunity for you to win the business in most cases. Highlighting your firm, building in this focus towards fiduciary governance and oversight. We think that makes a difference. And then just, always asking for the business for sure, but differentiating yourself based on what's important to the client. And you're figuring that out even in discovery meetings, but if you don't have an opportunity to do that, you're doing that throughout the conversation. So we think that's been super helpful, based on feedback from advisors. Again, we'll share this presentation with you, but I'd love to get any questions from you guys as we still have a couple more minutes and we begin to close in on time. Brian, Chris, any questions come in?
Yeah, no, I appreciate that, David. We'll open it up to a few minutes of questions here. Again, if you'd like me to run something by David and Matt, just enter it in the questions panel and I'll throw it at them. One that, and yes, we will be able to send out a copy of these slides, and of course, David can get you connected with their materials as well, should you like to leverage them for your practices.
Yep, and Matt, I'll let you have,
David.
Matt, I'll let you have the final word as we wrap up. But just to highlight, we're both regional directors. Matt covers the Northeast, I'm in the Southeast, and we would love to partner with you guys and spend more time specifically based on your firm and what's relevant to you guys. No two firms are the same, so we've got a lot of experience working with others, and we're happy to share with you.
Yeah, appreciate that. And a couple of questions that we get all the time, and there's probably no one right answer, but number one, obviously you guys have some great materials and thoughts once you get to the table with a sponsor. How do you get there? How do you cut through the noise and get that meeting or get that first engaged phone call with a plan sponsor who, we all know are hearing solicitations from from many advisors if they're a larger plan, maybe not so much in the super small or startup space. But any thoughts there from what you've seen from the best in that area?
I think that the most successful firms are doing quite a bit in terms of preparation in advance. So that might be wherever that lead came from. Maybe there's an in at the organization just to understand what the current arrangement looks like, investment specifically, maybe goals, if there's any pain points. That to me, I think is where you want to start. So is something wrong with the offering today, and how can I solve that issue? I think that's helpful. Understanding what drives the organization as a whole is another opportunity to potentially create an inroad if you don't already have that. So that might include social media, that might include LinkedIn, just getting a sense for what's important for the plan sponsor culturally, and if you can create some alignment, maybe understanding if they've done volunteer work in the community, maybe you host an event and invite them. But just try to create some connectedness between their firm and your firm from a values perspective. Matt, do you have anything to add?
Yeah, I would just add to that too, just understanding the audience's acumen, right? So Fiduciary Resource Guide that David presented, I think the guide itself is great for professional use, for financial advisors. It goes really in depth on a lot of different topics. I think where the value add for the plan sponsor, for the client is the unbranded PowerPoint slides that David pointed to. So take topics like cybersecurity, for instance. What are the best practices, best tips, sort of best resources out there to make sure that plan sponsors are staying in compliance with cybersecurity? And our newest one that David briefly mentioned, ESG. So I know that's kind of a topic that's slowly coming more and more popular. So certainly, kind of understanding the audience and understanding which resources are kind of best suited to those audiences.
Great, thank you both. A fee question. Assuming that our partner on the phone would be serving as a 338, which most are in our space, do you have any thoughts on fee trends or tools that you guys offer to help with benchmarking and appropriateness of fees for advisory services?
I'll touch on a couple things, and Matt, please comment as well. But I would say that we have seen a trend in terms of parity for 321 and 338 services. So I would say today it's really tight. There's not a premium associated with 338 discretionary services. And just broad numbers, I would say that for a $3 to $4 million plan, market is somewhere between 45 and 50 basis points. I highlight that one first because that's where there's a lot of action. Startup plans, very small plans, you might approach 100 basis points, maybe slightly more. And then for really larger plans, say 20, 25 million, it might drop down to 15 to 20 basis points, something like that. Now these are broad numbers from our benchmarking, and it does not distinguish or differentiate the levels of service. So it may be that some advisors are doing communication meetings, maybe financial wellness meetings, one-on-ones. Some may not. So I think the fees that you're charging, it's okay if they're above market, but are you providing an additional level of service that's valued by the plan sponsor? So that's what I would start with in terms of kind of framing. I will say that our benchmarking and both fee and design benchmarking that's available in the unbranded material, that's a great content for you to use. It's not coming off FI360 or RPAG, so you're not beholden to their database of plans. So use that as a template. It looks at record keeping fees, advisory fees, investment management fees, and you can draw from whatever resource you like, external resources in the public domain, to use as a benchmark. So based on the plan size, industry, all of that kind of number of participants, you can do that benchmarking for fees as well as plan design. So that's very powerful. From a plan design perspective, I would point you to Plan Sponsor Council of America. You can look at the demographics for a given plan, the asset size, participant count, industry, and it'll give you a very good sense for what is market in terms of benefit arrangements. Is it compelling? Is the current plan sponsor offering a program that's competitive to attract and retain talent? So I think those things taken together pretty powerful in terms of fees.
I appreciate that, David. And I think that does it for today. I appreciate all the thoughts and leadership that you all are bringing to the table. So thanks again to Matt, David, and to DFA. And of course, thank you all for joining us for this Epic Insight webinar. As a reminder, we will send out a follow-up email with the presentation and a recording of the session. And most importantly, we wish you safety and health as you support your families, colleagues, and clients. And please don't hesitate to reach out to us if there's anything we can do to support you all. Appreciate it. Have a great afternoon, everyone.
Thanks,
Thank you,
everybody.
everyone.
Thanks, guys.